I think probably the best one was flipping something that was around 30,000 into a seven-figure exit. Just that tweet that we shared openly netted over 100 listings. I think that you're about to see the unbundling of the MLS system. It's also the fundamental unit economics of how brokerages are going to make their money. The hidden inventory, it's actually a magnitude of order larger than what is currently on the MLS. It's just hidden. The number of people that are going to be able to make a living as a buyer's agent as a result is going to be impacted very quickly.
This is Axiom Alpha, where we talk about building and investing in businesses with unfair competitive advantages. You know that beer ad campaign with the most interesting man in the world?
I am familiar.
I feel like you're the female version of that guy. You went to a military college, started and bought multiple businesses. You worked as a VC advisor. You flipped 8 houses. You headed the expansion of a European startup into the US market while living on a farm in Amish country, Pennsylvania. And now you've launched a real estate tech company. Oh, and I think you're also a volunteer EMT and firefighter.
Yeah, and I spent some time in Alaska as a commercial fisherman too. That's not on my LinkedIn bio. I have a very circuitous, nonlinear background, and I would say that the thread that sort of weaves it is that I have always been attracted to, as Sebastian Younger says, people on the edges of things. So, borrowing from Ben Franklin, I guess I either wanted to be that person or to write and read about those people. So I've just been doing things that I think are at the edge of whatever situation it is. I mean, since probably pre-college.
That's awesome. I think I've taken a somewhat circuitous route, but it hasn't been quite as circuitous as yours. So I definitely admire that. I'm not sure how you have time to do this many things. Like in the process of doing research on you, found your Bigger Pockets posts, and I was like, wait, you also flip houses? When did you have time to flip 8 houses while also starting this company? Is since you're also advising a VC firm and you're also a volunteer firefighter. Like, I don't even understand how you have time for this. Do you volunteer like once a year, or like just that alone? How do you have time for that and work and maintaining a farm?
Well, full disclosure, none of those things happened at the same time. So I was a volunteer firefighter EMT, both in Connecticut, where we previously lived, and here in Pennsylvania at Manheim Township. I stopped actually because the pandemic shut down the volunteer program. So they went to all of their full-time staffers for a while. They did eventually bring volunteers back in, but it wasn't for the better part of 6 months to a year, and I had moved at that point. We only purchased the farm in April of 2022, or excuse me, April 2023.
So replace the firefighter side, weekends with the farm weekends.
Yeah, those two things were not coincident at all. And I would say it's trying to do something tangible. And the thread that sort of runs between those two things is that, you can make your money intellectually by doing something that is rigorous and puts a dent in the universe from a technical perspective. That's where I've been for years. But the satiation of doing something with your hands is real. And even if you don't choose to buy a farm, things like, restoring furniture or knitting something or whatever. A lot of people have these hobbies because the satiation of sitting down and doing something and then getting it done and seeing it accomplished is so much different than the long-term grind of building a 0 to 1 startup, which takes years.
Yeah. I have a couple rental properties that were in moderately rough shape when I bought them. And so it's been a process of constantly fixing things that didn't even know needed to be fixed. And so that sort of fulfills a little bit of my satiation. Plus, when you buy a property that the backyard has overgrown to the point where the weeds are small trees and you just take a chainsaw and go through the whole backyard, that's kind of satisfying.
Immediately, yeah.
That and tinkering with electronics, that's my other physical hobby. How many businesses would you say you've started altogether? I know you got started in content, so it depends probably on if you count different revenue generating websites as separate businesses, but like rough idea.
I don't have a count for if you're just talking about content-based websites. I would say the material ones are probably in the 5 to 6 range right now.
And what's been the most successful company that you've started so far?
I actually wouldn't say it's one that I've started. I think that the most successful thing that I've done has been creating something from an asset that already existed. So much like real estate or larger companies, the concept of distressed assets exists on web based assets as well. So, taking web based assets where either it had a lot of traffic and little monetization, or great monetization but very little traffic, and basically repositioning them and then flipping them has probably been the most successful single thing that I have done.
Can you tell us a story of like one of those instances? Because I think this is a pretty fascinating area for a lot of people. Obviously, finding a deal is one big problem. You know, if you have an existing platform like a niche specific blog, and then you can buy another niche specific blog that complements it and sort of share traffic between them, or you buy a small little web tool and then you sell it through your niche blog, then that can be a great return. But if you don't already have a pre-existing asset to build off of, how do you find those distressed opportunities? You know, on Flippa or Empire Builders or these, websites, it's pretty tough to find anything that's really that undervalued. How did you find this deal?
Off market, which is funny. Um, I would say the difference between now and say 2013, 2014, 10 years ago, is that there are aggregator sites out there that have some substantial like heft to them. There are a lot of marketplaces. And I think that what Andrew is doing over at acquire.com is fantastic. I've been really excited and inspired by some of those stories of people buying something and then basically putting it either into a micro PE portfolio or like a father son teaming up to do this after school. And it turns out to be helping to pay for college. Like, that's exciting stuff. That didn't exist 10 years ago in the way that it does now. Mostly it was uncovering something within a niche that I was already in, and then figuring out that this was an asset that I saw had a lot of traffic and then reaching out to them cold. It's no different than walking by a home and you're like, this clearly is unoccupied. I wonder who owns that. And then reaching out to whoever actually is on the deed to see if they would sell it. Same thing.
And did you buy this all on your own, or did you raise a fund to do this? Did you get any outside investors?
I have only been a bootstrapped entrepreneur up and until working within a VC backed company at the last company that I was at.
Interesting. And what was the monetary size there? Like, did you take a 10K website and flip it to a 100K website, or you take a 50K website and flip it to a 500K website? What did that look like?
I think probably the best one was flipping something that was around 30,000 into a seven-figure exit. But yeah, I mean, it's possible. It's a lot of work. I think that a lot of people actually within agencies, for example, have this deep niche of expertise in search engine optimization or in paid advertising. I think that applied to an agency model is a great cash flow business, but the agency owner operators that I've known for the longest period of time that have seen the most success are those that use that cash flow to basically fund the acquisition of assets that are owned and operated that they then grow into being very large lead generative or very large ad revenue or very large whatever businesses that they then sell on to a larger player in the space.
Yeah, makes a lot of sense. I mean, if you ultimately are that good, you're really good at driving traffic, or you really good at high ROAS ads, then it just doesn't make sense to spend that on somebody else's asset. I put $1,000 into advertising or content or whatever it is, and then I get a $5,000 of value. Like, just build your own website if you can find the deals anyway.
Absolutely. It's about enterprise value. Like, if you're working within an agency, whether it's within somebody else's or within your own, you're still fundamentally trading your time for dollars. You want to get to a place where you're earning income regardless of whether or not you're sitting at the laptop in that moment. And that requires you owning and building an asset.
So you were building websites, you kind of went into the agency world a little bit. Somehow you get into VC. What exactly were you doing with the VC firm?
Due diligence.
At least now their website says that they specialize in fintech. I don't know if that was the same at the time or if they had more of a blog content focus at the time. Like, how did they come to you, and what did that look like? What did they want you to do?
Relationships power the world, and that was no different. I was introduced to that particular VC firm through a mutual contact that I'd actually worked with when I was working on the previous company. Um, in that case, yes, Gauss Ventures is a fintech-centric venture capital firm based out of the UK. They were going through due diligence on several different fintech companies in that like 2019, 2020, irrational exuberance run up in the space. So I was brought in not to market the firm, but actually to tear down the marketing of these companies that they were evaluating for investment purposes, because my deep Like if you think about the T-shaped marketer, my deep channel expertise was in MarTech. So being able to break down, were the systems that they had in place adequate? Did they actually know what a customer was? Did their definition of customer map what was standard for that industry? What was their actual customer acquisition cost? Were these real? That sort of thing.
I think that's a super interesting thing to look at. What exactly is a customer? Like, is it somebody who signed up for your app but doesn't really use it? Is it somebody who uses it on a daily basis? Is it someone who logs in regularly but they don't actually use any of the functions? Especially if you're talking about fintech, maybe you want them to do more things within your app or less things, right? The things inside your app could be generating money for you, or they could be costing money. So, it makes a big difference as to what actually is the customer. What are you counting when you're talking to investors?
100%. And I think that the definition of customer changes across every category and sometimes within multiple individual companies within that category. So, for the people that are contemplating buying a business, understanding what the seller identifies as a customer is an absolutely crucial part of that transaction valuation. You want to understand exactly what they mean by that. And I would say it should have a revenue number tied to it, because a customer that is not paying them is probably not a customer.
Yeah, I agree. I want to get into that a little bit more down the road, but first I want to go to what you're currently building, because you tweeted about this the other day, moving this into beta, and I think it's super interesting. So you just started Galleon, a for sale by owner listing marketplace website, galleon.io. When did you launch the first version of that website?
It was a landing page as of September. I actually updated Twitter because I had people that had followed me from previous companies to let them know as a personal update that I would be working on this. And that post went unexpectedly viral. So we put up a landing page really quickly to sort of collect interest and build a wait list out. The website itself, the team had been working on in background for some time, and we actually released it quietly back in December and then let people know that it was available back in January. There are a few different parts of what you see that are not obvious but are non-trivial. The big key unlock for us in this beta release of Galleon is that we've taken actually listing your home from a 10 to 14-day process, which is pretty common for people that are listing on a traditional MLS with a traditional real estate agent. We've broken it down into 2 minutes. We were very inspired by the Airbnb model when they initially built everything out. They tried to make it so that it was 3 clicks to actually booking a room or booking, I guess, a whole house now. We wanted to try to think through how to break and simplify this down into the fewest possible steps with the least amount of friction. Our hypothesis was basically that most people are actually amenable to selling for the right price. We wanted to be able to capture as much of that as we possibly could. So, with a price in mind and with one photo, you can give us your address. We are auto populating all of the details and background, like the year that it was built, the number of bedrooms and bathrooms, the square footage. All of that is there so that you don't have to run around your house with a tape measure. Once you've given us the photo, then in background, we also are creating the description through AI or AGI that's automated such that when you get to the success page, you should see your home, your photo, all of those critical details. And then a first draft is the way that I would describe the AI generated description. You definitely want to go in and modify it and edit it as you want to see, as you would like to see it, because AI is still a work in progress. And then you just go through and basically modify the description and then list the individual amenities, which is just a bunch of checkboxes that you would be selling with this property. That's it. And then in 2 minutes, you're done. Then it's up.
I love the 3-click thing. I think that's also Steve Jobs, right? Like the original iPod, right? Was the 3-click
Yep.
design. You wanted to be able to get to any song in 3 clicks, and had to design the momentum scroll wheel so that you can actually get to things fast enough. In terms of real estate, are you worried that there's going to be liability issues with that, though? Because if there's anything inaccurate that AI fills in, you misadvertise the square footage or the number of bedrooms or bathrooms or anything like that can generate liability for the seller. You may not have direct liability, but if the sellers end up getting sued, they're not going to have a great experience. They're not going to refer other people. Do you guys have a solution planned for that?
Yeah. So I'd say the first thing is that what we're actually doing in background that may not be obvious from a business process standpoint is mutual KYC. So making sure that before we connect any potential interested party to buy, that we know that that person is who they say they are. And on the sell side, making sure that whoever has listed the property is who's actually on the deed, or if it's a KYB or know your business, that we can confirm that person is associated with the trust or the business or whomever owns that property. That's actually something that you don't get when you go to other real estate aggregator websites right now. The next change is that this is a straight peer-to-peer transaction. So what you do once you've matched is completely up to you. In the future, we will have something called Navigator that's coming later this year, where we're actually going to help walk people through that transaction with software, basically trying to give a Domino's pizza tracker or a progress bar, for lack of a better way to describe the transaction, so that you know where the buyer is in the process or the seller is in the process. And we'll actually map you to, in the future, attorneys. Real estate attorneys are a mandatory part of the transaction in 21 to 50 states, but we think that they're actually a very good idea for all transactions in all 50 states. And that's where you want your contract to be reviewed. Make sure that a seller's disclosure is reviewed at that stage. But to actually make the introduction to see whether or not you're actually interested in this house, that should be as low friction as possible. It's once you get to the, okay, we like this house and we're about to actually entertain an offer and we need to go under contract, that's when we have to button everything up.
Interesting. So I also saw on that Twitter thread, somebody asked about your business model, and you said that you were planning to monetize through vendors. It sounds like this would probably be the largest vendor. And so in a sense, you're going to be Zillow, but instead of realtor leads, you're going to be, lawyer leads. Is that accurate?
I would say, yeah. I mean, we're so early. We don't yet know exactly the way that this is going to go. What I'm trying to do is anticipate the changes that will happen, because this model is fundamentally flawed and changing underfoot right now. Where is the puck going and where is it going to be? I think the future is that some percentage of people will always transact with a real estate agent, but that's a bespoke service and will command a premium price associated with it. But for people that have done this a couple of times, like you've purchased a few homes, if you're comfortable with how that transaction usually happens, then paying 5 or 6% in an asset-backed commission is a big dislocation between value and cost. For them, there should be an alternative, and it's going to be direct or peer-to-peer. It's already happening. I mean, anecdotally, I keep getting people, whether via Twitter or in my DMs, that are like, yeah, I did this and I would never go back. I think for them, the 5% asset-backed commission is not only antiquated, but I mean, it's already antiquated. It's definitely not the future. So what we're trying to do is see, okay, if that's where the puck is going, if we've already reached what I'd call peak real estate agent, there's like 3.1 million real estate agents, 1.4 million realtors, 130,000 brokerages in the United States, but only 715,000 homes for sale right now. And this is sort of the peak of the year. Yeah, those numbers don't add up. That number, I mean, there's not enough market to satisfy the number of people that are trying to participate in making it happen. And telegraphing what we've seen already with the litigation, the Sitzer decision for the NAR, and then the 4 or 5 subsequent lawsuits that have been filed, it's not going backward. Like, centralization is not the future anywhere, and it's particularly not the future in the United States. So what does that mean? It means that in the future, there will be sort of this commoditization of how transactions happen. That means that you're probably not looking at an asset-backed commission. We think that it's probably going to bottom out, at least for the experienced buyer sellers, to something that looks flat rate.
Yeah, the wave of lawsuits triggered me to do a lot of research into this space, trying to look for what are the investment opportunities, what's going to change in this industry. I spent a lot of time analyzing businesses, and some of the most interesting businesses are ones that come out of, some sort of law or regulation change. There's a guy who created a couple gambling websites after online casinos started becoming legalized in different states, and sold them for like $40 million a piece. And then, after the 2015 tax law change that created expanded R&D tax credit for startups, that created a whole industry of profitable tax help companies. So this definitely seems like an interesting area to look at. As I've been trying to dissect this market and figure out where things are going, real estate on the one hand is a very simple industry. You don't have to be that intelligent to make money in real estate. On the other hand, if you're trying to disrupt real estate, it's actually a pretty complicated market structure, much more so than you're talking about regulated securities or commodities or anything like that. I mean, you have layers upon layers of network effects and other sort of moats that are in place. like the most obvious one is the MLS, right? Right now, you have the majority of listings are on MLSs, and there's this, broker reciprocity agreement, so it's hard to list both unlisted and listed properties on the same website. How do you propose to overcome that network effect of the MLS? Like, if you guys don't have a bunch of listings right now, right, how do you attract buyers to your site? The fsbo.com site, I don't know how much traffic they get, but not very high, like maybe, 20, 30, 40,000 visits a month, which is remarkably tiny. And that's one of the more well-known ones. How are you guys going to attract traffic without having a ton of listings?
Going back to the first part of your statement, I think it's actually an opportunity for us that there is that broker reciprocity agreement. I think Rex v. Zillow decision back in October was fascinating because Rex's business, they were a flat rate broker, I believe, focused in California. Their CEO is a guy named Jack Ryan. Fantastic name and a really brilliant guy. I actually shared a couple of weeks back on Twitter one of his statements at I think a think tank symposium where he was talking about how this bottleneck is a retarder on the entire industry in more ways than we can see because something like 1 out of 3 purchases is impacted by a home. So by bottlenecking how homes are transacting because of this centralization, we are actually impacting the economy in some much larger ways with second, third, and fourth order effects that we don't see but are felt. Rex was immediately affected when Zillow joined the NAR, I believe back in 2019, and then they put all of their other transactions behind one layer of friction or one layer of obfuscation. What followed was an implosion of their business. They sued, and Zillow just won that lawsuit, basically to ensure that this broker reciprocity thing, where MLS listings must be prioritized, could be maintained. And what that will mean is that everyone who lists on Zillow, whether it's a pre-foreclosure or a pure FSBO, is always going to be behind that one layer of friction. And if a buyer is not intentional about selecting it, they're never going to see that. That goes for all of the incumbents. Like Realtor.com is quite literally backed by the MLSs and the NAR. I don't think that any of these big aggregators are going to prioritize people listing their own properties, and that's our opportunity. From a traffic generation perspective, all roads eventually lead to search engine optimization, right? There's no way that you can get around that. But I think in the very earliest days, what we're going to do is focus on the markets where there is a big imbalance between buyer demand and seller supply. And if we can do that, if we can reveal what I would call the hidden market, we all know that exists. Like pocket listings exist. If you've had a home in a market that was desirable, you've probably gotten unsolicited flyers or text messages or something more onerous for that property. If we can help buyers see what is there that they can't otherwise find, that's our opportunity. So past sort of this initial, hey, we're out and we're live, we're going to focus on a couple of those key markets.
That makes a lot of sense. So somewhere that has very few listings coming up, if the MLS in a particular county only has 15 listings and you can get 20, or even 15, then, you're comparable in that market.
Yep.
That's a good strategy.
When we were doing, like when this was just a thought before we'd even spent any time doing customer discovery, I took a look at what at the time Fred said was the inventory. I guess it was July or August, July. And Fred said the inventory was like 699,000 homes. I was like, okay, how many homes are there? There's 145 million. Like, okay, single family housing units, that includes condos. And I was like, okay, so that's like 0.5% of the entire inventory is available at any given time actively, at least right now. And I recognize that we're in a cycle where there's very little inventory. So when we started doing customer discovery, I was thinking, okay, if 1 out of every 200 people are like me and they could be persuaded to sell their home, if somebody came along with the right price, then we would double what's currently on the MLS inventory. And what we found in our early customer discovery is that that number across markets is closer to 1 in 10. So it's not that the hidden inventory, this disaggregated pocket listing, and then groups of people that could be persuaded for the right price is at what is currently available. It's actually a magnitude of order larger than what is currently on the MLS. It's just hidden.
So you're saying 10 times the number of listings that are currently listed. That's the number of people who are, potentially willing to sell their house.
Correct. Now, not all of those prices are realistic. where I found it shook out was typically around a 10% premium for the most reasonable. We will have to, in the future, iterate our product to basically show buyers, like, based on market comps, this is a good buy, this is a great buy, or just remain silent on it if it's neither. I think that's something that we're going to bring out sooner than later. But for every one completely unrealistic person, including my own family members, when we were doing very early customer discovery, there are actually a lot of people that would be persuaded right now because we're in this weird market where people love their mortgage but have outgrown their house, or love their mortgage but like are ready to downsize, whatever the situation. So yeah, if you give them a little premium, they can be persuaded.
Have you done any research in your customer discovery process as to, somebody gives you a price, they're like, I would be willing to sell for this. And you're like, okay, you go back to them in the next conversation, be like, so looked at some comps in your area. It looks like this is sort of the area, like, would you be willing to sell for this price? Have you tried to estimate that willingness to come down from that premium?
I have not. I have not. What I have experienced as a homeowner that did exactly this back in 2015 personally is that I put a house up as a for sale by owner, and I was just trying to feel out the market because we were transitioning between companies. And I was really surprised by the amount of interest in that property. Listed on a Thursday, had a bunch of inquiries Friday, had two, open houses, and I didn't have the words for it then, but I was effectively doing KYC, like looking the people up that were interested to make sure that they were real humans and they weren't going to come and, stab my family. But once I had had that confidence, open the house up Saturday, Sunday, I had multiple offers. And my price was my price because that was the only price I was going to take to move. I didn't have to be flexible on it because I didn't have to go anywhere. So it made the negotiation as a home seller really simple. But I think that only works if you're in a market where the buyer demand clearly exceeds the seller supply. So I would say that the way home prices will shake out, like, comps are a part of the story, but really what determines price is what someone is willing to pay for it. So to me, that home might only be worth 400,000, but to somebody that has, two kids and wants to get into the school district, maybe that house is worth 500,000, and maybe that's the premium they pay for it.
What is the user experience from the buyer? Can I go and just submit any offer to any house that's listed on there, and then there's some sort of offer management or offer notification on the other side for the seller?
Yes. So what happens is you express interest in a home. We send an email confirmation back. We are doing KYC on you to make sure you are kind of who you say you are. And then once we have confirmation of that, we already will have had confirmation on the sell side that the seller is the person that owns that home. Then we'll connect you. And then what happens past that is up to you guys. That's not up to us at this point.
Is that KYC process based on looking at public records? So like you have someone, submit a driver's license and then you look them up in the public property records and say, okay, this person is listed on this deed. Or, if let's say that they own through an LLC, how are you verifying that? Are you having them, submit a certificate of incorporation? Or are you just looking at this person did a quitclaim deed to an LLC, so we assume that they're the owner of this LLC? How does that work?
Yeah, KYC and KYB practices are pretty standardized. The good thing about this company is that it's been formed by a group of people that just did a consumer finance company. So we deeply understand how to do this in background. The KYC process for a human could go to doc and selfie, but most of the time, doc and selfie, which is what you're talking about, like show me your driver's license, isn't necessary because there's enough readily identifiable information that they basically create a fingerprint of who that person is. And if enough of those data points match, then KYC is confirmed. Doc and selfie is usually for when something is off, like the number is wrong or the email address and the number aren't recognized. On Know Your Business, like the KYB side, that is much more involved, and that might include having some documents actually shared with us.
So you have this sort of statistical, you're matching up a number of data points. What's the fraud rate on that? Or like, what's the rate of, misestimation there? Because I would imagine you guys are not charging for listings. So one liability claim is pretty high, right? If you accidentally allow someone to list a property that they don't own and sell it, and someone pays for it and then they don't actually own it, that seems like a pretty large liability issue. Are you relying on the fact that, well, they're going to go hopefully do this right through a title company and lawyer? But again, if you're not enforcing how they interact, The fake seller could take advantage of a buyer and tell them that, oh, this is not really necessary. You know, it's my property. We can just do it informally. And then the buyer wires them 400 grand. And suddenly your company is liable potentially for hosting a fake listing. How do you control that risk?
So the quick answer on KYC and KYB is that we are not a KYC and KYB company. There are a lot of companies in the space with whom we are partnered that are actually really good at this, and this is their bread and butter. This is what they do. So we're relying on the strength of outside partners to be able to give us good data back. There's no question that there is inherent risk in a transaction. Anything that involves money has inherent risk. So we will have to have risk mitigation measures in place. But in the earliest iteration of what Galleon is, we're simply matchmaking. We're showing you inventory and we're giving you an opportunity to engage with somebody that is selling a home. You do have to do your own due diligence. That's why we want you to actually hire an attorney to draft contracts and to review documents. In every state, you will still have to have settlement and title is going to have to be searched. These are basic parts of the transaction for everyone. So there are a lot of different points in this transaction process that do need to be gone through legally. First iteration of Galleon is here's somebody that's interested in your house, take it and go. And that's always going to be free. Later, when we introduce the Navigator product and start to basically help and walk you through that, we will take on more risk. But that's why that product will have remuneration to it, because we do have to pay to make sure that we're managing that risk for you.
Makes sense. The Navigator would definitely be useful. I mean, if you can enforce that the person does the transaction through you, then you can at least enforce that there is a title company that has been contracted to assume the risk of, a title issue like what I was describing.
Yeah. I mean, title insurance is an absolutely massive business for exactly this reason. And I would say,
Or you guys could be a title company. That would be another revenue stream.
we are not going to be a title company. I would love to say.
Maybe you'll acquire one down the road.
For every step of these transactions, as we go, to be very clear, the limit of our ambition is not defined by a marketplace. I think that the marketplace is the right opportunity to sort of engage the people that I think are going to be willing to think outside of this traditional box that the industry has been in since 1913 or 1940, if you go by the year that the commission rate was set. I think that the kinds of people that will engage, that will do this themselves, that will take that risk, are the kinds of people that recognize that effectively what you get right now is project management, calendar scheduling, and document preparation. But it's a misconception that the traditional agent model does anything legal. They don't. That's why 21 of 50 states actually require that you have a real estate attorney at signing, because they want to ensure that. I think that the settlement agent value is enormous because of the same thing in states that don't have an attorney. You want to make sure that this is done correctly. But the traditional model is basically just a project manager, for you individually. We just want to take that same project management aspect and basically scale it, because the incremental value over time of being able to scale that project management is huge. And I think that most of this stuff has already been solved for other industries with technology. Like the whole concept of Robinhood would have been foreign to my grandparents, but the way that we transact securities is unrecognizable to my grandparents, but the way that we transact homes is exactly the same as it was not only for my grandparents, but my great grandparents. It's an absurdity.
I agree. So many times I've thought about how irritating it is. I think I'm sort of your target customer in a sense, because I find very little value in the real estate agents I have worked with. I'm a pretty in-depth researcher. I do a lot of due diligence on investments. So if I'm looking for a property, I am scrounging around, like finding every article I can read about in that area. I'm like researching, finding all of the crime statistics in the area, finding multiple rental comps in that area. Basically, the only thing that I don't have access to is the MLS. And I'm more than happy to just show myself in, but you can't do that because of the lockbox rules. So you basically end up paying for someone to escort you, even if you don't want an escort, and giving you local market knowledge, which is something I read in a 3-month-old article that doesn't really give me any extra value. But I've also done a lot of research into studies of what the actual statistical value is of the MLS. Obviously, every agent tells you like, oh, it's 17% more that you get from putting in the MLS, but that's biased because that doesn't account for the size of the house. It doesn't account for other observable features of the house. But to the best that I can determine, there is a premium that you get from listing in the MLS because of the broader reach that you get, because of the fact that it's available to more buyers. So if your target market is someone who's more experienced, someone, more like me, for sale by owner sounds great, but why don't I just use a flat fee MLS listing agent? Because then I get that MLS exposure, and I know that there is a premium that comes from the MLS that outweighs the 2.5% that I'm going to pay to a buyer's agent.
I think that's a good pitch. I mean, if you want to list on the traditional MLS with a flat fee, by all means, I think that the value is distribution, but I don't think that that's locked in for the future. And you can look at the December 21st lawsuit that Zillow brought against the two MLSs on antitrust grounds as sort of a canary in the coal mine that that's about to change. In the past, the aggregators broadly, so not just Zillow, but Trulia and all of the other predecessors, really needed the MLSs to play nicely with them because MLSs had the leverage in that relationship. The aggregators needed them. I think that lawsuit is really interesting because it shows that the future is the big aggregators now having the leverage and being okay with potentially prodding for compliance from these partners they've relied upon for so many years. And I think what that telegraphs in the future is back to aggregation theory. There's disaggregation and there's aggregation. There are two forms of value as old as time. So I think that you're about to see the unbundling or the ungatekeeping of the MLS system. It may not be this year, it may not be next year, but I do think that it's coming. And I think there will be increasing pressure from the outside as we're dealing with antitrust lawsuits at both the NAR and now the MLS level to do that. So I'm not building a company for 2024. We're building a company for 2027, 2029. Like, what does it look like then? And I don't think that the MLS stays gatekept. And I think that distribution, as we've previously known it, will become more fragmented.
So let's do some spicy predictions here. How do you think this rolls out? You mentioned the Zillow lawsuit. For people not familiar, there's a lawsuit going on with a relatively large MLS where Zillow is suing it's actually a group of MLSs. Zillow is suing this group of MLSs because the group used to use a showing. So you have a listing, you want to book a showing, and there was a software company that the MLSs were using. Zillow bought that company, so now Zillow owns the showing scheduling software, and the MLSs kicked out that software. They replaced it with their own software, and now Zillow is suing, saying this is anti-competitive. If you don't integrate us, then there's no chance that anyone's going to use us. You can't just use your own software and not allow anyone else to do this. If I were designing the law here, if I was an antitrust legislator, I would say make it an open API. Like, if you're an MLS, you have to publish an open API that lets any vendor attach to that API to schedule showings. Maybe you can impose some minimum requirements, like, we impose licensing requirements. You could impose like a review requirement or something. But basically, if you're a vendor and, anybody can build a scheduling software and connect to this API, in that world, the MLS survives. It still maintains its monopoly over the listings, but it's easier to interact with them from a vendor or an aggregator point. Does that help you in any way, or do you need more than that? Right? How do you think that plays out?
I think if that's the future where MLSs have something open API, then I could see an opportunity for us working with MLSs. The key for Galleon is that it will continue to pursue becoming a marketplace for unlisted properties, meaning for people that don't want to go through the conventional agent system. So if the conventional agent system changes and it's no longer gatekept, then of course we will revisit that decision for whatever is best for the customers. But I think looking into the future, there are a number of pieces of this transaction process that are about to change based on the players themselves. And I don't know why, or I don't know when anybody is going to make these decisions, or of course how these pieces of legislation are going to happen, how the lawsuits will shake out. But what I can say is that if you take a look at the listing agent contracts between 2023 and 2024, there is already change for multiple brokerages. What had previously been standardized language that included in print, not variable, 6% is no longer there. So now you have the opportunity at every single kitchen table to negotiate this rate with your real estate agent that you may not necessarily have negotiated or known that you could have negotiated. And that's the key, because I think most of them have told me, and I get it. At one point, I was also a licensed real estate agent, that that rate was never standard, which is the language that they're no longer supposed to use. But we've all been paying 5 or 6%, and there really hasn't been much negotiation room in the past. That's about to change. What's more interesting is that these broker contracts are also now specifically itemizing what percentage goes to the buyer and the buyer's agent and what percentage goes to the seller and the seller's agent. It also, in at least a couple of the contracts that I've seen, now asks what happens if the seller finds the buyer. Who gets that? And so I think that the immediate impact is going to be to things like dual agency. Dual agency is, I think, legal in 36 or 37 states, and probably more than it's probably more than that. So don't quote me on that. Dual agency is super common.
Even some states that don't have dual agency legal, like Florida doesn't have legal dual agency, but it has an equivalent, which is like you can have a transaction broker.
Exactly. Exactly. So there are workarounds, but I think dual agency is going to be immediately impacted by these national brokerages that have changed their language. Um, I think what was previously like a check in the box 5-6% is now going to be a negotiation at every kitchen table. And I think that the number of people that are going to be able to make a living as a buyer's agent as a result is going to be impacted very quickly, probably within the first year or two. Simply because if you have to have that negotiation, and we already know by the NAR's own statistics that I think 94 or 97% of all homes are actually found by their buyer, and then they bring the real estate agent into the transaction. Like they find them online and then they bring the real estate agent in. It's not driving like it used to be 20, 30 years ago. I just don't see them being willing to give them 2.75 or 3%. I just don't see it happening. So that's going to have an immediate impact on buyers agency, which will have an immediate like pressure on listing agents, which is going to compress the already very thin margins for brokerages. So you can play that out. Like what's going to happen in 2, 3, 4, 5 years is not just what happens with the lawsuits. It's also the fundamental unit economics of how brokerages are going to make their money and how many brokerages and how many real estate agents there are. And then all of the downstream businesses that rely on ad dollars from real estate agents and brokerages will be impacted.
So, what would have to change for the MLS for you to work with the MLS? Is that reciprocity agreement the key thing? Like, let's say that they change the rules according to the Zillow lawsuit. They say, okay, we have an open API for people to schedule showings. And my prediction, I would say more than 50%. I won't say it's 100%. It's not even, highly confident, but more than 50% chance is my prediction that whenever the injunction is issued for the Burnett case, that includes or is soon after followed by a DOJ order that they say, NAR, you have to order the MLSs not to include a database field that is a unilateral offer of compensation to a buyer's agent. So if that's removed, I think that'll be one of the main changes that's ordered, probably from the injunction in the Sitzer Burnett case. From Zillow, I would like to see an open API. I don't know if that's realistic. I don't know if that'll happen, but I feel like that's a reasonable solution. If I was designing the solution, that seems like the good solution. Let's say both of those things happen, but the reciprocity agreement stays in place. Do you stay as an unlisted off-market or for sale by owner only marketplace, or do you dip your toes into the flat fee MLS listing area as well?
I'm always going to stay open minded and do whatever is in the best interest of buyers and sellers. But I would say that our North Star is to enable people to transact for themselves. So, for as long as this is a gate kept ecosystem that requires people to have a real estate agent in order to be represented, we will not be a part of it. I think that it's fundamentally not the future. I think people should be able to direct and transact their own homes. And it's kind of silly that we can do like you can sell your car on Facebook Marketplace and also Craigslist and also Auto Trader and also cars.com, but you still have to transact your home through the MLS. It's antiquated.
I agree. I am just mostly curious from the perspective of like the pricing, right? Like if you're trying to attract sellers to list their home, and I know that I can get more probably on the MLS statistically speaking. So if I can list on Galleon and then also you guys have an option for do a flat fee listing on the MLS as well, then that's great. Then I enjoy that option. I'm not sure exactly how the reciprocity agreement would come into play there. And I think FSBO.com, I believe, at least used to have an option where you could do a flat fee listing as well as listing on their website. I don't know how that interplays with their, with the reciprocity rules.
I'm not sure. I'm not sure either. I haven't dug into too much to FSBO.com because, to your point, their traffic is fairly insignificant. And that's really why that's why we're building this, is that I, as a human, have a home in the neighboring town that continues to get unsolicited offers. And I went to go and list it and found that there was no option anymore to do so anywhere, really, in any kind of method that was viable. And it just seemed so silly. I'm not interested in going through the traditional real estate agent process. I'm not interested in spending 2 weeks. I'm not interested in having to, have showings. I'm interested in saying, hey, world, this is my price. And if you can meet this price, then I'll sell it to you. But barring that, don't bother with the flyers and please don't cold text me anymore because I'm not interested. Uh, that doesn't exist right now, as far as I can tell, as a homeowner, as a human, as a consumer, and I think that it should. In the future, getting back to what does it look like if there is this disaggregation, if it becomes more fragmented, I think that our value prop simply being enabling people to transact their own will always stand the test of time. And if you take a look overseas, which is usually how you can pretend the future, um, real estate agents are somewhere in the 1 to 2% commission rate in most European countries. The United States is an extreme and extraordinary outlier. We've seen some of the large aggregator CEOs sort of telegraphing that they want to be able to maintain a free and open listing because they think that that's what's best for the market. But if in the future their economics are compressed, then they might have to move to a separate model. I think what that's really saying is, hey, if we can no longer monetize with 66% of our revenue for an agent advertising, then we're going to have to monetize in a different way. And what that will mean is that they're going to have to charge to list. So if and when that happens, that becomes a real value opportunity for Galleon because Galleon will always be free.
I think it's even more than that, right? That 66%, what that's Zillow's last year's revenue from buyer's agent advertising, right? But I think that also includes wind down of Zillow offers or whatever their home buying business was, their iBuyer program. So I would guess it's more like 75%, right? Like they have a serious innovation, dilemma going on here in terms of not wanting to challenge their existing business model.
I feel for them. I mean, I've been in a company that was of size at least where change is super hard and it gets magnitudes of order harder, I imagine, at every level larger than that, right? Because you have so much to do to protect and preserve your current cash cow, but you have to sort of cannibalize that in order to build for the future. It's classic innovators dilemma stuff. It's, Kodak with digital photography, it's Blockbuster with streaming, it's classic. They're going to do it. There are smart people there at the helm, and I'm sure that they will. But it's going to require re-engineering of every one of these companies. You can see that already with Redfin. Its CEO said back in, I think, November, or excuse me, it might have been right before the Sitzer decision, actually. You can, I'm sure, look it up. But he did leave the NAR because he no longer thought that it was value adding. It was fascinating to see an article in The Real Deal this weekend that said basically that post the departure of their president, which I think is the third departure they've had at like the C-suite or top of chain at the NAR in 5 months, that realtors actually think that aligning with this organization is more of a hindrance and could be ruinous to their reputation, not additive. That's a problem, like a fundamental problem that they're going to have to face, and sooner than later.
Yeah, I think it's really just the network effect, just that MLS. That is the reason why anyone signs up to be a realtor, because they control that.
Exactly.
Like, they control access to the inventory and they control access, at least in some areas, to the lockboxes, which also prevents innovation. The lockbox control, I mean, that would be another thing. Like, I would like to see a lawsuit against that policy, because if an MLS, which many MLSs have this, they own the lockboxes and they rent them to the agents when they have a listing. And that means that there's no way for a listing agent to do anything really innovative around showing. I am an investor. I'm a repeat buyer. So I would like an option where I can just do a background check and then let me go see showings on my own, right? Like that would be great. But, instead of it, that's like you have to do a background check and take a test and pay realtor fees, and then you get access to the MLS, even if you don't want to be an active realtor, just so that you can show stuff yourself. So it's like you're really forcing. I mean, if you see 10 properties before you buy one, and let's say it's $50 a showing in labor, like you just add on $500 of labor that you didn't need. Like you're already going to see those in person. You just add $500 of extra cost by forcing someone to go with you who you don't need, don't want, don't get any value from. It's just required by the rules. That irritates me a lot.
And that's what I mean. It's just hard to look at this current model and real estate agents and brokers are some of the people that I've talked to most often who agree. It's hard to look at this model and say, yeah, this is going to be the way it is in the future. It's hard to look at this model and believe that centralization is the future. Decentralization is happening everywhere in every industry and touching everything. It's happening in jobs with the rise of the gig economy and work from home or remote work. It's happening in currency, obviously. It's happening in citizenship, like the rise of things like the digital nomad or nomad capitalist, for example. Like decentralization is happening across the board, and this industry, because of its structural centralization, whether you call it a monopoly or not, I guess is a legal question, but the structural centralization is stuck in time. And it won't be. Like, there's now market forces happening. I'm very grateful to the lawsuit, although I didn't bank on it, because it's actually educating the consumer about this being an issue. Great. It's happening from legal perspective. It's happening from market force perspective, because this paucity of inventory is making prices artificially high in some areas where it shouldn't be. And it's happening, at the personal level of the people that are actually a part of it. Their margins are being compressed because even if they want to be able to do something in a cleaner, neater, more efficient way, they can't.
Yeah, right now so much of the broker budget is just advertising because of that fact that you have this huge oversupply of realtors because the commissions are so inflated and propped up. So you just end up having to spend a ton, which I think is probably part of the reason why flat fee brokerages haven't taken off more than they have, because they exist, and if you are a repeat or an experienced seller, it makes a lot of sense to do a flat fee listing. Take your own photos or hire a professional photographer, write a good description, and that's it. That's pretty much it. I mean, you got to answer some phone calls. You could hire a VA, to answer calls for you and schedule showings. And there's just not a whole lot of value add for that, 2 to 3% of commission that's going to the seller's agent.
No.
But somehow flat fee listing brokerages still haven't taken off. So it's like I've puzzled over that. Why is that not more popular? And it seems like one of the main things is probably just the fact that they can't afford to advertise as much as all the other brokerages, so they don't end up getting as much.
I haven't been in a flat fee brokerage, so I can't say, but there's no question that distribution is going to matter a lot. Distribution will matter to Galleon. I think that there's also no question that the way that the current leading real estate companies are leading is by being able to reinvest their more ample funds back into advertising, in the same way that there's a joke about venture capital backed companies basically being a very efficient way of boosting Facebook and Google shareholder value, or Meta and Google shareholder value. I think the same can be true for, over time, the various aggregator websites for real estate agents. The cost per lead is extraordinary and climbing. And now that they're going to have this compression on the number of buyers agents that will be available to pay these ads, you can assume that the ad costs are going to continue to go up. So there's going to be pressure on this from all sides.
How did you go about getting your first listings? Like, let's say first 10 listings.
Twitter for sure. Right now, like just that tweet that we shared openly to say, hey, we are now available, netted over 100 listings.
Wow. How many listings are you guys to total right now? More than 1,000?
So in background, we haven't populated all the ones from our initial wait list. That wait list was over 1,000. Right now, it's whatever is up on the site. I haven't checked this morning.
What was the reason for not uploading all of the ones that were on the wait list?
Because we're a brand new startup, and I wanted to make sure that the experience was something where we could be a good first impression, or as good as we possibly could. So we were bringing people in sort of by hand, walking them through it, and then watching as they were encountering problems. Like one of the first bugs we fixed was that the save button was below the fold. And so when they had edited their text, they didn't see where they should be able to save their listing again. That kind of stuff.
Gotcha. I do have a suggestion. So I was browsing on it this morning, and you guys have some $0 listings like Zillow, which I don't know if that's new construction or a bug, but I know that $0 listings or like $1 listings like drive me nuts when I'm looking through Zillow, because it messes with the filter. I'm trying to search for stuff in a certain range. You're giving me this fake $0 listing. So I don't know if that's new construction, developer listing that on or what it is, but I would suggest don't let $0 listings, and force people to put an actual number that they're going to accept.
I believe that is a developer. I think I know exactly who it is, and that's a good suggestion. We'll implement it immediately.
I know you before this, you were in charge of Curve. So Curve, I think, is the fintech company you were referencing, is a European, UK-based startup, kind of universal aggregator of cards and other payments. You were in charge of bringing Curve to the US market. I think you guys sort of had bad timing. You rolled out right as the pandemic hit. Ultimately, I don't think you guys were successful in rolling out to the US. I think the US website on Curve now says something like join the waitlist for our comeback or something like that. What do you think went wrong? Was it just the pandemic, sort of threw everything off, or what was wrong with that rollout strategy, and what did you learn from that?
So we were definitely influenced by the pandemic broadly, but the most difficult thing is actually the difference in the regulatory environments. So in the EU, UK, there are not one, but there are many fewer regulatory bodies with whom you have to be in compliance with. There's the FCA in the EU, or excuse me, UK, and in the EU you have the ECB. So the structure of the Curve card abroad is a decoupled debit card, which means something a little bit different from a legal standpoint as decoupled debit here in the United States. But effectively, a transaction is happening on the front, and then another transaction is happening on a card in background, which allows us to have that, allows them, I should say, to have that unique all your cards in one. In the United States, decoupled debit is regulated by the Durbin Amendment. And so we had to create a brand new product construct for what that might be that would both fall in line with what was allowable by the Durbin Amendment, but wouldn't be completely upside down from a unit economic standpoint. That was very difficult. I would say that probably took the better part of 12 to 18 months to just figure out from an engineering standpoint. When we actually launched, it was 2021, and that was only into what had at that point been our waitlist. It was just the wrong time for the market, like period. It was the wrong time, not for launch specifically, but it was the wrong time for Curve because we no longer had the ability to really plow funds into it because we had enjoyed a broadly valuation in 21 or 20 and 21, and now the market was beginning to turn in 2022, and Curve made the right decision of deciding to consolidate its resources on its existing footprint and then reduce it from its expansion markets, which not only included the US, but also a lot of its European footprint.
That makes sense. Have you guys raised money at Galleon so far, or do you guys plan to do so? How are you funding the rollout so far?
So we have not yet. This is entirely bootstrapped. I do anticipate actually closing a small pre-seed round probably within the month.
Nice. Still looking for investors? So I'm interested if you're still trying to close that.
I was going to say yes, but the times right now will be oversubscribed.
What is your rollout strategy? I heard a couple interviews that you did in the past when you were at Curve talking about the importance of focusing on a very specific customer segment with a very specific problem. When you're looking at Galleon, what is your specific market segment and specific problem?
I would say for us, the specific market segment of sell side are people that overbought short-term rental properties, single-family home short-term rental properties during the pandemic, and are currently sitting on a non-performative asset. I think for them, it makes a lot of sense to try and take something that's a liquidity event quickly and then be able to reinvest those funds into something else or to refill their coffers because they've been carrying the carrying cost of not actually having something that's getting occupied through. A lot of those markets, or I should say where it was overbought, also happens to overlap neatly with some markets where there's still a lot of buyer demand, but there is no supply, in part because it was gobbled up by over exuberant short-term rental investors in the prior, I'd say, three years. So right sizing those markets are going to be the key. And I think that how we think about moving the market in a single market in the future from a customer acquisition perspective is effectively a flywheel, making sure that every listing is seen by multiple people within other, call them captive local sites. And that generates more traffic backward to Galleon, raises more brand awareness such that other people see Galleon, the value prop of being able to list in 2 minutes, whatever your price is, and create a new listing. And then it sort of turns into itself.
I love that answer. The people buying Airbnbs that are now regretting their decisions, that seems like a great market to go after. I'm curious on the unlisted video that you guys posted on Twitter with a sort of 2-minute explanation of how Galleon works. You had a description that was like, you had 3 things. You're like, no real estate agents, no days on market. Is that no days on market from your customer discovery? Is that something that you found was a hindrance? Like somebody who overbought, they're contemplating listing, but they don't like the idea of they're like, well, I would take money, but I don't want my house to just sit on the market and accumulate these days on market, which are sort of like little tiny black marks on my property that then will prevent it the next time around?
Absolutely, yes. That's a big part of the friction, not just the friction of having to find a real estate agent, sign the documents, and schedule all of this stuff to actually get done in your house, like stage it before it actually gets listed. That's huge friction. But the long term friction is actually the days on market. It compresses price and everybody knows it. So I recognize that that's a feature and not a bug. I recognize that's an intentional part of the existing MLS practice, but I'm happy to take the other side of that bet. I think that there is a much larger chunk of the inventory that would be made available if you didn't artificially compress their price and allow them to wait and see if there was a willing buyer at that price in the future without having that artificial compression. You know it because you've bought and sold homes. If you see something that's been listed for like 90 days and has had no price movement, you just have a different expectation of it than something that was listed yesterday. Even if it's the same house with the same like it's the same across the board. If you see 90 days on market and then one, you just will have a different expectation of what that seller would be willing to sell for.
That is a very interesting point, because that's certainly the expectation that I've had in the past, looking for, I'm going to look for something that's been on the market for quite a while and then try to lowball or at least underbid, with the list prices on that. At the same time, there's also studies that show the realtors keep their own properties on the market longer than customers. And it's not like a huge disparity, but it is interesting, that there's so much emphasis. And like you said, it's a very intentional feature of the MLS that it's advertised like, oh, you want a realtor who can sell your property fast. Like, and it's kind of unfortunate because I feel like so many people buy into it that it becomes like a non-pain point. Like for some people, right, they're like, yeah, my realtor helped me sell my property, within the week. I'm like, probably didn't get a very good deal then. You probably sold for too cheap. But they've been convinced that selling fast makes a realtor good. And if they have a good realtor, therefore they must have gotten a good price. And it's like, that logic doesn't quite work.
It's like sitting at a table at a very busy restaurant, right? Like the waiter is there because they want you to move because they need more people to be in that seat at that table in order to realize more revenue. The idea of having days on market and moving and selling your home quickly is not necessarily what serves the seller. It does serve, however, the brokerage. It does serve the wider market because that means that there are fewer clients and they're turning over and they're going to generate a lot more revenue. I think that, again, it's a feature, not a bug, and it does apply for people that are what I would call motivated sellers. And that's who you see on the MLS right now. Motivated sellers are event driven. They've got, a job change, they've gotten married, they've had a baby, they're downsizing, they've gotten divorced. Like there is a reason why you go through this friction right now. You are motivated. And for them, days on market, yeah, it actually has some financial impact to them and they want to move quickly. So that makes a lot of sense. But since we don't have that kind of customer, since the people that will list on Galleon are not event driven, they're opportunistic. It's just a fundamentally different customer. It doesn't make any sense for us to continue to have this, days on market thing that's just going to compress their price.
So I have a question, hypothetical, but just wondering as I'm thinking about this. If your goal is to take the unmotivated sellers and open up that market, as an unmotivated seller, I am not going to necessarily be checking the property price very quickly, right? Like someone offers me the right price on any of my properties, sure, I'll take it. But then I have to be like, okay, I have to look up comps, try to figure out what the value of my property is, list it. 2 months later, I may decide that that's not the price I want anymore. I have to go back and update it. So I would imagine that one potential issue that you'll face is, okay, I come and I list my property at the price I would take today, but in 4 months from now, I may want a higher price. What if you instead flipped everything around and you basically made it so it was like Zillow, you have a Zestimate equivalent, you estimate what the price is on all the different properties, and you just let me go to your website and opt in. I just basically go and say, yes, sellers can contact me, and you have a nice little offer platform that lets them make offers, and I can just, you send me an email if and when someone sells me an offer. Then I don't have to be constantly keeping up, right? The Zestimate sort of serves the purpose of giving people a rough idea of what to offer, but then they can offer whatever they want above or below that. And I don't have to keep up because, again, like you said, I'm not a motivated seller. I'm not on the MLS. I'm an unmotivated seller. So I'm not going to keep going back and updating the price. What do you think of that idea?
Yep. So in our first go, we want people to actually list a price because we think that creates the most value for the whole marketplace, meaning both buyers and sellers. But I think that a feature that we can offer in the future is to simply say open to offers, meaning I don't have a price in mind, but I'm open to offers if you will consider that. And then letting sellers opt in if they are open to offers in the future. I think that's a way to do it. But to solve the immediate problem of you've listed a price, we will prompt you. We are prompting you, and we're making sure to look for state changes in the event that you have sold the property. And if you are non responsive, then to keep the marketplace as clean and performative for the buyers as possible, we'll remove the listing.
Do you have criteria for that? Like how responsive does someone have to be to, to have their listing not removed?
We're developing all of these processes as we go. Right now, we're looking for a check-in once every 30 days, but we'll see. It's really going to be probably the thing that we work on the most from a process orientation perspective is how do we take that which exists on the MLS is basically static information and make it dynamic.
Gotcha. What was your customer discovery process? It sounds like you have done a pretty good job of talking to a lot of customers and figuring out what things they really care about. Did you cold email a bunch of property owners, go find all the property records and start emailing them? Did you just go through your network? Is it all Twitter? How did you find people to ask what problem they actually care about?
We actually were very disciplined about following, I believe the book is Four Steps to the Epiphany and the Disciplined Entrepreneur. We basically followed those processes. The company was born of people that had previously worked at the prior company that we've just left. So we knew that we wanted to continue to work together, and we knew we wanted to work on a big, meaty problem that would put a dent in the universe, change something, and that the revenue numbers would not be measured in bips, but would be measured in real dollars. That was basically our criteria. So Galleon, as we know it today, was actually fourth or fifth idea that we went through. And we went through a very aggressive process of cycling through business ideas for the better part of 8 to 12 weeks. When we initially brought this out, what we did was commissioned a survey, an empirical survey, to sort of prove or quickly disprove the hypotheses that we had had. Like, for example, that it was a learning from one of our early survey results that people who have bought and sold a house more than twice, meaning they have are at least in their second home, but if they have already sold one, that's sort of the 50th percentile would try something other than the traditional real estate model. And every additional house you have bought and sold, once you get to 4 plus, it pretty much plateaus. It's almost 90%. They believe that they can do this for themselves. They don't require having that level of anti-anxiety medication or handholding or project management, whatever you want to qualify it, that the traditional real estate agent model supplies. Once we had those survey points, we then wanted to understand more about the why. So then we started doing some qualitative surveys and a lot of interviews on the other side of that. So for that, we reached out to, I would say, friends and family, and then +1 degree of separation and +2 degrees of separation away. And we did a ton of interviewing. We learned a lot, especially from people that are single family home investors, whether that's because they're doing short term or they're doing long term. We have a few people in there that have some multi exposure as well, but I would call it anything that's FHA or lower, so meaning four units or lower, quad or smaller, are the people that we were interviewing. Once we really sort of found that that was going to be our arterial vein of people for whom we would find and create the most value.
Yeah, that makes a lot of sense. Although it also is a little bit concerning, I guess, because you're trying to create enough listings that makes it worthwhile for someone to come look at Galleon instead of the MLS. Investors make up a small minority of the market. They're valuable from a buyer perspective because they buy repeatedly and they sell repeatedly as well. But if I need a lot of listings, I want to tap into that unmotivated seller market, how do you expand from there, right? So you get the initial investors on board, but you need enough listings to compete with the MLS, who has, this sort of monopoly on all the existing listings. If I only have 3 listings and the MLS in the same area has 25 listings, then how do you expand beyond those investors to attract other sellers?
That's going to be our crossing the chasm moment, right? That's the classic startup question. I think it would shock most people to know the number of homes that are currently owned by other than their occupant. It's right around a quarter of the housing inventory. And that means that a ton of inventory is tied up in either institutional, sub-institutional, or what I call mom and pop investment portfolios. So the value that we're providing for people that are looking for a home is basically giving these investors who are the ones that will be most sensitive to things like making sure they get the most yield, making sure that they're not having their price artificially compressed by days on market, getting those people to be able to more frictionlessly list clears and opens up space where there isn't any right now for normal people that just want to buy a house in like a suburb of Dallas. That's where I think we're going to be able to provide the value. How we get to the crossing the chasm, how we reach that mass market is TBD. But what's very clear to me is that a lot of housing inventory is currently held by institutions, sub institutions, moms and pops, short term rental portfolios that might actually be available. They're just going to be the most reluctant to sell until they absolutely have to.
You said 10 to 1 in terms of market size people who would sell within that 10% premium. What did you say the ratio was? How many more times, are willing to sell at a 10% premium versus people who are listed on market?
The statistic was that we needed 1 in every 200 people to be persuadable in order to duplicate the inventory that's currently available on the MLS. And that when we were doing the research, that it was 1 in 10, that was closer to our average that we shook out across markets that would be persuaded. I also said that there is a premium attached to the price, and I was fully expecting it to be like 2x, 3x, like my completely unreasonable aunt, who I love if she's listening to this, but she's being a completely unreasonable human. I think that what we were surprised to learn is that that number is much closer to like 10%. Most people, and I'm talking about the sub 1 million price point, when we were surveying people with qualitative consumer research, like the interview stuff, most people were going to attach something like a 50K to a 100K premium, which sounds like a lot, but it's not. It's not when you do the math. And if you think about it, right now, if you're paying a 6% asset based commission, the average home in the United States is 430,000. That's 25K. It's on balance going to be a small premium over the traditional way of finding it, but with more inventory.
Right. Although I guess from that side, it's like the seller is potentially saying that they want the 10% premium plus not to pay the 6% commission. So they want a 16% premium, which comes a little bit more. But in the end, I guess if you're talking about you need 1 in 200, you can get 1 in 10, then even once you narrow down to the set of investors, let's say it's 10% of that, it's 1 in 100, you still have enough potentially to compete with the MLS.
Yeah, it's such a massive market. It's such a massive market that making even a small dent will help the entire marketplace. But it's so big and right now so stuck that we're just looking to try and nudge it behaviorally into the direction that it will eventually go.
When you said you wanted to be generating revenue dollars, not bits, have you thought about, what is the first thing that you're going to monetize? You said vendors, going to bring in lawyers, title insurance companies, maybe photographers, maybe. How long do you think it'll take you to, introduce that first monetization layer? And what do you anticipate in terms of like unit economics?
We're definitely going to have a portal for people to engage real estate attorneys, insurance. I would say the big four are going to be title, insurance, mortgage, and legal. That's the big four for everybody. I think those are all going to be partnerships that we sign and have some kind of lead generation relationship with within the next 2 months. Beyond that, I think the Navigator product, or what I would call our owned and operated sort of consumer software package, is going to be the largest single revenue driver for Galleon in the future.
Owned and operated product, what is that?
So instead of generating leads for somebody external to us or taking ad dollars for somebody external to us, actually having a consumer-led software.
So what is the monetization? Like you're charging sellers, you're charging buyers?
The native would be to actually charge the seller to be able to transact natively within one platform. But I think that...
Gotcha. So it's like the Navigator piece that you're talking about. You're charging for like the transaction management.
Correct. As an alternative to DIY and sort of flying by the seat of your pants or paying 6%.
What do you expect to do for pricing on that?
I think that the software package itself, so I'm analogizing it to TurboTax because those are the 3 tiles I see in my head. Filing your own, fully DIY, that's free. So if you want to list on Galleon or you want to contact the seller, that's free. Being able to watch the progress and understand where it's moving on either side of this transaction will be a consumer software Pricing is probably going to be comparable to what other consumer software packages will be. I'm guessing somewhere in the Dropbox range. And then I think the fully eventually Navigator, once we've figured out our own risk and legal and regulatory requirements, we have to think about RESPA, for example. Once we're able to actually help people facilitate the entire transaction and marry them with legal, marry them with title, do it all through us and through partners that we have baked in, either in-house or a more strategic relationship, that will be a flat fee. So instead of engaging a real estate agent to do the full transaction for 5 or 6%, we want to be able to offer it for probably around 5,000, and then it doesn't change based on the house price. So it's 5,000 whether you're selling a $1.2 million house or a $400,000 house.
Love it. Are you seeing a trend in terms of, we're getting 1% more listings per week or 5% more listings per week? Or is it very sporadic still because it's mostly based on Twitter leads at this point?
What's so weird is that we're starting to see people that are telling other people about us. We're not driving it, which is great. Like all marketing, advertising roads eventually lead to one room of word of mouth. And we're already starting to see that, which is really exciting. But we are literally 4 days or 5 days past public right now. I don't know. We'll see.
It's amazing. Well, I appreciate you coming on, Amanda. This has been super awesome. Thanks for answering all my questions. It's galleon.io is the website if you guys want to check it out. Thanks so much.
Thank you.